On Wednesday the 19th of August, 2026, the single currency is pulling off a move that has traders watching one number closely, 1.1600. Euro to US dollar has extended its rebound towards that level, according to Danske Bank's morning note, and the engine is not rate cuts. European yields remain elevated, while US Treasury yields have stabilized after a recent spike. In plain terms, the gap between what Europe and America pay on government debt has narrowed, and that is quietly tilting demand back towards the euro. It is a relief rally, but the question today is whether it has real fuel or simply less bad news. Yields matter here because they set the reward for holding a currency. When European yields stay high and US yields stop climbing, the dollar's advantage shrinks. This week's move follows a pattern. The dollar retreated as the euro extended an overnight bounce on relief that Europe might avoid the worst economic fears. At the same time, investors are piling into European stocks on the back of the strongest earnings season in nearly 4 years, and public Europe is outperforming the US. That equity demand is another tailwind. So this is not just a euro story, it is a European risk appetite story, with bond and equity flows moving in the same direction for now. The current impact cuts both ways. For euro-based investors holding US assets, a softer dollar has already eaten into returns. Vanda Research recently noted that what looks like a decent US return translates back into euros at roughly 0.5% because of the dollar's depreciation over the past 2 months. That is the hidden tax of this rebound. For importers and consumers in Europe, a stronger euro helps cool imported inflation, especially in energy. For exporters, a rise towards 1.1600 squeezes competitiveness. So the move is not neutral, it redistributes gains from US asset holders to European consumers, and it changes the calculation for anyone hedging currency risk today. Looking ahead, the calm could be brief. Markets are shifting focus towards key US inflation data, and the direction of the next move depends on whether the Federal Reserve can still sound patient. Danske Bank's note highlights the stabilization in Treasury yields, but ING has warned that renewed dollar demand could return through the summer, with euro to US dollar vulnerable towards 1.13 or 1.14 if the Fed delays easing deeper into 2027. In other words, this morning's push towards 1.1600 is happening inside a broader caution zone. If US CPI data surprises higher, the yield gap could widen again fast, and the euro's rebound may look like a stretched bounce rather than a trend change. So the takeaway is this: the euro is extending its rebound because European yields have stayed firm and US yields have paused, not because the dollar's problems are over. That is an important distinction. The 1.1600 level is a magnet today, but it sits near a battleground where one hotter inflation print could reverse the trade. Watch European bond yields and the next US CPI release before trusting this move. For now, the euro has the momentum, but momentum in August can vanish by Friday.